We have Meenakshi Dawar, who's fund manager at Nippon India Mutual Fund, joining us. Meenakshi, thanks a lot for joining us. And I don't believe that we've spoken before. So welcome to the show and thank you for being with us. You know, we have been talking about these all-time high kinds of levels, which seems like the market has just been evading that. Do you think we're set for a longer time-wise correction and that we should perhaps expect to be ranged at these levels for a while before we can see a decisive move higher?
See, market is very difficult to predict in a short term, but like we have seen, last 2 months have been quite good for the market, and a lot of stocks which have reversed in last 1.5-2 months. But there is a lot of good things that have also happened, right? So if you look at the big worry for the market, which was the inflation, that has been coming down. And considering a lot of commodity prices, etc., have also corrected. So the yield pressure that was there in the market some time ago, that has definitely eased off. If you look at, on a medium term to long term, it is what we should worry about is the earning growth trajectory of the market. And if you look at the earning predictions going forward, a market can comfortably deliver that 15-16% earning growth rate. So a lot of sectors have been doing reasonably well, and there is a lot of confidence that this earning growth will be met. So any investor, who want to play this market for next 1 year to 2 years perspective, there is reasonable confidence on this earning growth. So I think we should just look away from this near-term volatility, which is going to be there, considering how globally the macro is evolving, how globally things have been little volatile. But in terms of earning confidence in the Indian market, we are quite confident of market giving that 15-16% earning growth rate for next 2 to 3 years.
Okay, Meenakshi, we have been seeing this mid-cap rally really pick up, more interest in the broader market. I mean, we've seen it in the mutual fund flows as well, right? Where mid and small caps are getting money and large caps are perhaps losing and seeing some flows move out. Take us through what you expect in terms of just the broader market action. Do you think this is something that will persist as well, where a bunch of the action comes in from the smaller stocks?
See, if you just look at how things have evolved post-COVID, definitely the structure of the market has changed. In terms of earning growth delivery, the market has definitely become broad-based. So a lot of sectors which were not earlier participating in this growth rate have come back, and they are decisively giving us confidence that the earning growth rate or the trend of business is looking upwards from here. So if you look at a lot of these sectors which are from these mid caps and small cap space, which are, a lot of these capex related sectors, which can be a housing capex or industrial capex, a lot of these specific consumer discretionary companies, which can be hotels, hospitals, QSR companies, etc. So they have definitely come back. So if you look at the participation of growth rate in the broader market, a lot of sectors which were not earlier participating in the growth rate have definitely contributed to the growth rate. And going forward also, there is reasonable amount of confidence that this growth rate will continue. So market rally has been quite broad-based. More so, what I'm trying to highlight is that is because the earning participation or the growth participation from these sectors have also been quite good. So as long as this trend continues, which we are quite confident on, we don't think the market will become very narrow from here.
Got that. Meenakshi, hi, Surabhi here. So if we look at the key holdings of the Nippon India Value Fund, I see a lot of financial names on it. There's ICICI Bank, HDFC Bank, SBI, HDFC, Axis, I mean the entire universe, so to speak. So tell us what's the thought process from here on, because, if you look at the last year, then it was a year of banks, last 12 months. They outperformed the Nifty. But if we look at this year, the calendar year, then the bank Nifty has been sort of not doing too much. So what's the sense that you get from here on? Because of the fact that perhaps, we're expecting lower margins Could that pressure banking stocks, or do you think the focus will remain on credit growth and therefore we might see a bigger rally perhaps in the second half?
So a lot of points that you mentioned. See, last year was a very good year for banking sector because everything was going right for them. So if you look at credit growth, that was trending above the trend line. There was no asset quality risk. And in terms of margin, the margin resilience was quite good. Now, if you have to predict, so these are the three most important variables which will decide the performance of the banking sector going forward as well. So if you look at things going forward from here on, the confidence on the credit growth remains quite good. So we will see that a lot of these companies will show you that 17-18% credit growth. In terms of credit quality, the credit quality is behaving very, very well in this cycle and going forward also, because if you see the leverage in the balance sheet, may it be corporate balance sheet or the retail balance sheet, they are all in the good shape. So we do not say that asset quality will deteriorate much from here. The only third variables which is of concern for the market is the performance of this margin. So if you look at margins, there are three variables that can impact the margins from here. First is that interest rates going down from here on, which is the view that will have some amount of negative impact on the margins of these franchisees. The other more important variable, according to me, is also the competition intensifying. So if you look at, because the availability of capital is good, liquidity environment is good, a lot of the big banks and NBFCs are now chasing same consumer or the same corporates, and therefore the competition is very, very high. So your ability to make disproportionate margins from here on is quite low. But we believe that this story is quite strong and any investor can expect reasonable amount of compounding of their returns from here on because entry point of valuations is not very high.
Okay, got that. Meenakshi, financials we've spoken about. Are there any other pockets of the market right now which you think, even at these levels, are, if someone is to put fresh money to play, are there any pockets which look particularly exciting to you right now?
So, yeah, we remain quite positive on this whole capex cycle. So, India had struggled for this capex cycle for a reasonably long period of time. It is only in last 1.5-2 years that we have seen this capex cycle has come back. And we believe that there is long runway for growth for this capex cycle to continue. So now, if you look at there are multiple things to this capex cycle. So we are quite confident on industrials. We are quite confident on cap goods. We are quite confident on housing capex companies also. So these can be a lot of these allied companies, which can be building materials, cements, wires, etc. So this whole basket looks quite promising to us. And in terms of consumer, we do believe that consumer is not very broad-based. Consumer cycle is not very broad-based. Still, the mass segment of consumer is not recovering, and the recovery is maybe some time away. But if you look at certain pockets, which can be, premium pockets or sectors which are evolving sectors in the country, which can be QSR companies, hospitals, retail, diagnostics, all these sectors we are quite constructive and positive on.
Okay, those are some spaces that you like. Meenakshi, it was great to have you on this show, and we do speak to, have you back very soon so we can discuss your bets a little bit in more detail. But with